This video is brought to you by TogetherBudget.com. Welcome to the world of passive index fund investing, where simplicity meets effectiveness. Index funds track a specific market index, such as the S&P 500, by holding a representative sample of stocks in that index. Imagine having a fund that mirrors the performance of the entire US stock market. That's what an index fund does. It gives you exposure to the broad market, not just a few hot stocks. One of the key benefits of index funds is their ability to provide broad diversification. By holding a representative sample of stocks, you get exposure to various sectors and industries, reducing your risk. When it comes to exchange-traded funds, they essentially index funds that trade on an exchange like stocks. This flexibility allows you to buy and sell throughout the day at current market prices. Imagine you're a time traveler going back to the early days of investing. You see people trying to beat the market using complex strategies and tactics. But then you stumble upon a simple yet powerful idea: passive index fund investing. This approach is not about being lazy or uninformed. It's about embracing the reality of the market, that most professional investors can't consistently beat their benchmarks. By tracking a broad index, you can tap into the collective knowledge and wisdom of thousands of companies. One of the key benefits of passive investing is its scalability. As more people invest in index funds, the costs decrease and the potential returns increase. It's a self-reinforcing cycle that helps even the smallest investors participate in the market. So, why passive investing? By embracing this approach, you can take advantage of the power of compounding returns, reduce your exposure to individual stock risks, and align your investments with your long-term goals. It's a straightforward way to build wealth over time. Welcome to the world of passive index fund investing, where simplicity meets low costs. Our topic today is benefits of index funds, low costs, diversification. Benefits. Let's dive in and explore why this approach has gained popularity among investors. Imagine having a fund that mirrors the entire stock market, minus the complexity and fees associated with individual stocks. That's what index funds offer: a diversified portfolio at a fraction of the cost. Index funds have gained popularity due to their ability to track a specific market index, providing consistent performance and low costs. This makes them an attractive option for long-term investors seeking steady growth. When it comes to taxes, index funds are often more tax efficient than actively managed funds. This is because they don't incur the same trading costs and turnover, leading to lower capital gains distributions. Index funds are a type of investment that allows you to invest in a small portion of the overall market. They track a specific index, like the S&P 500, and aim to replicate its performance. Tracking error is the difference between an index fund's performance and the actual market index it tracks. A good index fund should have a low tracking error, which means it closely replicates the market index. Index funds use various methods to replicate the market index, including sampling and full replication. Sampling involves selecting a subset of securities from the underlying index. In conclusion, understanding how index funds work and their tracking error is crucial for investors. By choosing a low-cost index fund with good replication, you can achieve long-term investment success. Passive index fund investing is a popular investment strategy that involves investing in a fund that tracks a specific market index. This approach aims to replicate the performance of the broader market by holding all the constituents of the underlying index. There are different types of index funds available, each catering to specific investment objectives and risk tolerance. Equities index funds invest in stocks, providing exposure to various sectors and industries. Fixed income index funds, on the other hand, invest in bonds and fixed income securities. These funds offer a lower risk option for investors seeking regular income. International index funds provide exposure to global markets, allowing investors to diversify their portfolios beyond domestic borders. These funds can be used to invest in developed or emerging markets. When it comes to investing in the stock market, two popular options are exchange-traded funds ETFs and mutual funds. Both allow you to diversify your portfolio by pooling money with other investors to buy a mix of assets, such as stocks or bonds. One key difference is that ETFs are traded on an exchange, like stocks, whereas mutual funds have a net asset value NAV calculated at the end of each trading day. This allows for more flexibility in buying and selling. In passive index fund investing, ETFs are a popular choice due to their low costs and flexibility. By tracking a specific market index, investors can gain broad exposure to various asset classes. In conclusion, ETFs offer a low-cost, flexible way to invest in the stock market. Whether you are just starting out or looking to diversify your portfolio, consider using ETFs as part of your passive index fund investing strategy. Passive index fund investing, also known as ETFs, has gained popularity due to its simplicity and efficiency. A key benefit of ETFs is that they track a specific market index, such as the S&P 500. One common approach to investing in ETFs is to create an example portfolio, which can serve as a starting point for individual investors. When constructing an example portfolio using ETFs, it's essential to consider factors like asset allocation and diversification.